Hello, ladies and gentlemen. My name is Sasha, and we are watching Modern Investing. And I would like to introduce my co host, the ex Wall Street professional, Peter Bennett. Hello, Peter. Welcome to the show.
Hi, Sasha.
Founder of the network, Mr. Nick Paliveda. Welcome to the show, Nick.
Hey, Sasha.
Okay. So, market today is fabulous. Actually, I had a conversation with my friend yesterday. Market was up. And I told him, but watch what's going to happen tomorrow. And I said, he asked me what's going to happen tomorrow. I said, well, look, if you look at several past weeks, you will see that the biggest gains stocks had on Wednesday. Why Wednesday? It seems to me that all the worries are being absorbed in Monday and Tuesday. Now, people prefer not to hold the stocks during the weekend. So the best way to do it is on Wednesday. Then Thursday it will be distribution. Friday people gonna close their trade to get the profit on the books, and so I'm not expecting so much movements Thursday and Friday. But Wednesday is the day, and today is the day, right, Peter?
Well, I think it's coincidental. I think it's bounce backs, but there was supposed good news. I think that was the first thing I was going to say. The markets are crazy in a way, because first the big news, I believe it was last week Wednesday, around then, the Fed said, "Oh, we're only going to hike a quarter point. It won't be half a point." So the market was ecstatic, but there's a problem with that, which is the Fed's going to have to hike a lot, because I believe inflation and oil prices are going through the roof, and I've been saying for 6 to 9 months. The other thing is today, oil is down to 117. Oh my gosh, what a relief, right? The only thing I could also think of is maybe there's a little hope because of Ukraine. There was a 12-hour ceasefire, so maybe they think Putin will be a little more reasonable. But these are big problems, and this is not going away. And the market's ignoring it, on any good news maybe, because the problems, which I've been saying for, again, 6 to 9 months, is oil and inflation. And now with Ukraine, first of all, nobody knows how long this is going to go. It could, if it settles tomorrow, the market's going to love it. Then oil prices will go down a little bit. But they didn't really go up that much because of Ukraine. Biden is saying, oh, it's Putin's oil prices. But it was already very high. But now it jumped up again. But it was going to go high anyway. So, and I'll give you some interesting evidence on that too. But the problem is, in the long run, the problem is the oil companies are not producing. And last week you said, well, the frackers are going to come through. So, but I happen to see something today about energy companies, and several of them, one I even put a little money into recently, but Devon, Pioneer, Continental, these are the big frackers. They do a lot of fracking in Texas. They do a lot of fracking all over. They're saying we're not going to be doing a lot of drilling, even if the price goes up. And this is for a lot of reasons. But one, they know the business has been cyclical. Two, the Biden administration, has put a lot of pressure on them with regulations, and it's the most anti-energy administration you could imagine at a time that we need the energy more than ever, because of not only Ukraine, where Europe gets 1/3 of their oil and gas from Russia. So at least the government hopefully will begin to recognize the significance of oil and gas strategically. But in Europe, it's going to need a lot of it, especially if they don't get it from Russia. But here's the interesting first of all, about Ukraine is, I was going to say, World War I, people thought was going to last 1 to 2 weeks. And it lasted many years. I didn't know that till this week. So It could go years or it could go a week. But either way, in the long run, it's the same two problems I've been talking about: oil and inflation. We are probably in a 70s environment. Nobody knows what's going to happen, but we're probably in a 70s type environment where we could see inflation at 7%, 8%, 10% a year. The last CPI was 10% almost, consumer price index. And so I have some interesting charts that show that I came across. So this is, first of all, you won't be able to see a lot of it, but this is oil prices. And you'll notice how close these lines are. So what this says is basically after every spike in the oil price, that's a dark line, there was a recession. Every single one until this last one, if I can reverse it right here. So the this is a history of spike after spike after spike, and then recession, recession, recession. And the only spike on this chart since 1970 that wasn't followed by a recession is the current one. So that tells you we could be in for a recession very easily. Second of all, this is the 2 and 10-year chart, which is all I've noticed, mentioned this before. And this is the Treasury 2-year rate versus the 10-year rate. And what this tells you is every time the treasury rate starts going up, recession, 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 except for this one. So it's the same pattern. The market doesn't want to go into, the economy hasn't gone into a recession yet, but both the Fed needing to raise rates to control inflation is very scary for the market in terms of this. And this is the scariest chart of all. This is PEs versus the inflation rate. And what somebody did is they reversed the inflation rate. So what that means, and you'll see a pure correlation, except for at the end here, for the first time, it hasn't matched yet, right? So what this chart tells you is every single time since 1980 that inflation went up, the PE ratios went up and the stock market went down, and vice versa. So if you look at this, you go, wait a minute, look how closely it matches. And I know this is a little complicated compared to the other charts, but all of a sudden there's a huge gap. So this says right now the average PE is around 7 or 8, but the index for inflation is as high as it ever has been. The last time the index was this high in terms of in terms of inflation, we're talking about basically in 1996, and the PE then was around 25, 26. So that would be what's called PE compression, which means that um, the companies we could see a 30, 50% drop in the market or more, maybe even more. It could be really bad. It depends. Nobody knows where oil prices go. That's another point that I wanted to make, which is I keep reading about people saying, well, when are we going to see demand destruction? If there's not enough oil, when is oil going to, and that's an interesting discussion I want to have with you, Sasha. But some people are saying, like Wells Fargo says, it has to go to 138 before there's any demand destruction. I saw a chart that said based on previous um, uh, inflation and what it is today, it needs to go to 200. Goldman Sachs says 132. Other analysts says 200. I say it could even go higher because people are using less energy as a percentage of their budget now. What you have let's talk about reality, what this means. You have a lot of retirees and wealthy people in the country. They're not going to stop driving if it goes up $2 a gallon. Maybe they'll stop a little. A lot of people need to go to work. So we're not going to probably get a lot of demand destruction in the United States until the price goes way up. I don't know how high. But the Biden administration isn't doing anything about it. He's calling it Putin's price increase, which isn't true because it already was high, but although Ukraine's making it worse. So, and the policies are terrible. I mean, I don't want to get too political, and so I'll give you 1 point for Biden and 1 point against Biden because it's an economic show. So the point for Biden is, this is an article I just read today. Energy CO2 is way up in the world. So carbon is actually higher last year than it has been ever. Now, part of that is China, by the way. 1/3 of that is China itself. So I don't know what the U.S. can do. But I understand the concern, because if you really believe in global warming, maybe you want the price of oil to go up. So that's why I can't figure out, is the Biden administration just doesn't want to tell people that we need to do this, but they're not being totally honest, because they're saying there's nothing they can do when they could reduce regulations, they can drill it in on more, they could stop the regulations, they can, do so many things. So the energy companies aren't coming to the rescue, and Biden's not coming to the rescue. So that I could tell you, for whatever reason that is. So then you say, what's the reality? Because I don't want to keep talking, but that's a lot of it. But so you said, where do you put your money? So I've been very, very conservative, more and more every week, for the week after week. And I'm happy to say my portfolio, the S&P is down 12% in the last month. I'm at zero. Basically break even. And the only reason I wasn't making a lot of money is because tech is down so much, and I think that's an overreaction. So here is the other thing I was going to show you, and I'll go through it, but it's a list. And this came from, I just found this on Schwab today. And it says, in high and persistent inflation, what sectors should you be in? And this matches what a lot of, on the previous chart I showed you. So they say consumer staples, and I'm going to give you little notes on this. So I was in consumer staples a lot, and I want to disclose this. I had RHS until this week. I did very well with it. But I read an interesting thing that said consumer staples does well during inflation unless it's sudden and intense inflation. So then I started looking at RHS's holdings, Pepsi, Walmart, Costco, and a lot of other companies like that, the cigarette stocks. And I went, wait, if inflation really is going to kick this high, they have a lot of debt. These companies generally have 40 to 50% debt on their books. And if Fed rate has to raise rates, that's going to hurt them a lot. So I pulled out of RHS, I pulled out of P&G. I've got very conservative. I'm actually 12% cash now. I don't think the market is going up a lot, but it could tank based on those PE ratio chart I showed you. It could go down 30%, 50%. If inflation looks like it's going to be persistent, and I think it will be. Then they say energy, which is obvious. We don't know what will happen in Ukraine, but there's a huge demand for LNG, and I like natural gas, not oil. Healthcare, but Schwab mentions, which I've said before, that price controls are a real concern here. So there's some risk. And I think that might happen in the future. Real estate, I've mentioned this many times, but I would say you have to be very selective, and office is a disaster. I read today, in the last week or two, I heard that office vacancies are now 35%. It's a huge amount of vacancies, and it's not going to clear up, I don't believe. They said utilities are good, but it can be hurt initially by big increases again. So this is my fear, that the market may tank, as the market realizes and as the Fed raises. And then they have a question mark on information technology. They said previously tech was not the place to be, but they said now there's more and more demand and it's become less cyclical. So they don't know how that will do. Then there's a lot of things you should avoid: consumer discretionary, financials, industrials, materials, all of these. And I add to that anything to do with foreign Europe, which is so dependent on energy, Japan. These are not places I'm putting a dollar or very few dollars. So you have to be extremely cautious what to do. And so I'm holding some cash, thinking when rates go up, maybe I'll lock in higher rates.
Well,
But
my opinion is that everything what you just said, I agree with. The only question is if the market's present prices already include a lot of these problems, like a war in Ukraine, like higher interest rates, hikes by Feds, and all that. There's nothing new about that except war, which started about 2 weeks ago. So that's a new factor. The inflation fears, it's been there now for several months. So the Fed's raising rates, it's been all well known. And possibly, if you take a look at some stocks, for example, stocks which I know quite well, for example, like Nvidia, right? I can't figure out how the higher interest rates war on Ukraine, how they can really impact a business of a company like Nvidia. Yes, perhaps something went, but Nvidia already went down all the way from 340 or so to what is today 250, probably 255. So it's already substantial move down. Actually, it's no, it's less than that today, but it could jump $20 any day. I wouldn't worry so much about that company and similar companies like I would think Microsoft, I would think AMD,
Yeah.
or even Apple, which is probably more cyclical, but they have so many goods and new developments and so on. So it's very difficult for me to dismiss the stocks and to be fearful. The only thing is you can decrease your position on those stocks that I just mentioned. I'm against writing covered calls because what happened is that the stock may move higher in the very near future, and you will either have to buy your covered calls at loss, or you will lose your position in the stock. So let's see if Nvidia today say, I'm not so sure what's the last price on Nvidia. Just hold on, let's take a look.
I think it was around 227.
227.
Right.
Okay. So
Yeah.
if that's 227 and it was 340, and there's no reason why, okay, maybe it will not get to 340 real quick, but I think,
Sasha, that goes along with what I'm saying, that tech
yeah,
is not.
absolutely.
I have right now options. I sold puts on Amazon, Microsoft, and Google, and KLAC. Which, by the way, I read something about KLAC interesting that says reshoring is going to help them a lot, and this could help them even more because as the U.S. brings back more, they're going to need more of these chips, this chip
Right.
testing. So it might shift, and they might have just as many chips, but if it's back in the U.S., they're going to need to set up testing here. So, but look, I don't know about Nvidia. I happen to like KLAC more because there's a dividend and there's a couple factors. I
Right.
feel like they're the winner no matter what happens. But again, this is the question of tech. Nobody knows how it is. But the question is, if I and in terms of the markets, I'd like to say, you know, first of all, we've had 20 or 30 years of the Fed put. Nobody is. The market goes up, the market goes up, the market goes up. It's been great for 20 or 30 years, but that's because interest rates are near zero. But what happens if that reverses? And I don't know if a lot of people are forecasting that. First of all, some people think, oh, oil will come back down, and I think it will to a point. But I'm saying I believe there's a worldwide oil shortage now. I don't think the supplies are going to be there. And so my question is, if we're short on oil, what price does it have to go to until the consumer has to creates demand destruction? Because somebody's going to have to give up their oil in the world, and the price is going to be the factor that equalizes that. So, and I think it's going to be probably at least 140 minimum. I mean, Goldman's saying 130, but I think it could easily be 200, or maybe it'll be even higher. Once people are going to be desperate for oil, so it'll be like the shock maybe of the 70s, and that's what caused the 70s inflation at such huge rates. What if we're going to, and I don't know, I could be wrong. That's why I keep a diversified portfolio. But I would not be surprised, I'll put it that way, if we're heading for very high inflation for a very long time,
It's
given
very,
the labor
it's very
shortages and oil. And then the Fed has to raise rates at some point. And once Fed raise rates, recession. And then where do you put your money besides dividend stocks? The safest dividend stocks.
absolutely. You just hit it. High yield dividend stocks, that's a place to be. So even if they will go down in price, as they
Mm-hmm.
probably will with the market, first of all, their price decreases will be not as severe as other stocks. And we already saw
Yes,
it in the last few
historically,
years.
yes.
Number two, their high yield dividends and those stocks that, for example, I'm involved, their dividends are well secured by profits and future profits or so on. Most likely, if they will go quite a bit down, most likely they will start buying their own shares, which will protect the
Yeah, you're right.
fund.
There's two
Or they will
protections.
increase dividends. One of two things will happen because the
And
cash
the
is
dividend, if the price goes down, the dividend yield goes up. So that's some
absolutely.
protection. But
So even
here's the interesting thing that I did. I'd never have done this before so carefully, but I started looking at dividend stocks and I started looking at debt because there's going to be two kind of companies if rates are going up through the roof. There's a kind of company that has 50, 40, 60% of debt to assets, and very, so, or there's also companies which I've picked out, which, I'm going to go once I get off oil, because I keep giving oil recommendations for month, and I have some more this week, but I even have one of these. So I like a company like I'm going to give you this week later in the show, which has nice cash flow, but very, very low debt to assets. But then you look at a P&G or a Walmart. That's why I sold RHS. I started looking at all these companies and going, wait a minute, they have 50% to debt to assets. Right now, the cash flows on these consumer staples are maybe 20 times, which is like a 5% yield. So there's not that much. It's not like a 20 cash flow. That's what I want. I want to, and I have a lot of these companies now, enough of them at least, but not enough to fill in all my cash. But I want to see a 20 cash flow, which is like a 20% cash flow yield. And so that even if the debt, and then low debt, like 10, 20%. So now if interest rates go up, no big deal, because they have so much cash flow. And so it's the safest companies. But I'm not convinced that the consumer staples, P&Gs of the world, are going to do well if we're heading for the environment that I am not sure of, but that's the way I see it. I've never been so concerned about the market now. I mean, you saw that PE compression chart. And if there's inflation for a long run, it's going to hammer these stocks, a lot of them.
Now, the previous shows, the real correction and where it all stops, when there will be a panic, there will be margin call, when people will sell anything and everything and so on. That hasn't happened yet. So this is still ahead of us. The only thing is now with electronic trading and margin calls, you have to settle almost next day. And so on, I think that panic will be very short-lived. It could last probably a couple of days maximum. It's not going to last.
Except for one thing. What if the market realizes the inflation is lasting longer and longer, and it doesn't happen overnight? Because, look, the S&P is down 12% in the last month. Oil prices are up. The Fed says, oh, I'm going to raise a quarter. And the market's like, oh, it's great. It's great. It's like, but how's the Fed going to control inflation? When inflation is running 7 to 10, it needs to be controlled for the consumer in many ways. And the only way for the government to control it is to raise rates. Once you get raised rates, it's going to hurt a lot of businesses. So, but what if it could happen gradually? I mean, look, it's a random walk, right? And that's the theory of MBA school. You just really can't predict. And so that's why a diversified portfolio is good, why dividend stocks are good. But who knows? But I am worried because I don't need to take that kind of risk with companies that I'm not, because I don't think they're going up a lot. At this point, I think that they're swimming against the tide in terms of oil. And who knows? I mean, if oil goes to 150 or 200 and sticks there for a long, long time, it's not going to be good for the market. I'm not sure. No, I can never be sure. But I'm cautious. I'm very cautious. And that's why, of course, energy is the number one place to be. And especially I love the pipelines, as I said, MPLX and EPD have been doing very well because, I get the dividend no matter what happens. And as long as they don't ban oil altogether, which I don't think they could do, that's always been my favorite MPLX. Now it gets to be too big, but.
No, right now, the idea is cash. I'm in cash about 14%.
Oh, interesting. Close to me now. I was saying at least 12 I am.
No, I'm 14. No, you know what? I remember it was time, I don't know, 30 years ago or so. There were a lot of seminars how to make money in real estate. So their suggestion was, okay, you buy property, you put a little bit cash, then you buy another property, take a mortgage, then you buy third property, you put tenants here, tenants there, so on. But at the end of the day, there was a time suggested that you have to sell all your property, maybe except one where you live.
Oh.
Sell everything, get into cash. Why?
Right.
First of all, you will feel how well you're doing. You're sitting on mountain of cash.
Right.
And you can become very selective of your next move. So right now, you see, the problem is that a lot of people are got into their holdings right now in stocks. They have certain strategies what they're pursuing and all that stuff. And by now, a lot of people already have red figures in their portfolio. They're
Yeah,
losing
that scares people. Yeah.
stocks here and there, so they're getting scared. But it's not a panic yet. So that's why, although market is fabulous today, but I know that something is still ahead of us. Hopefully,
I think I'm fearful, but you know what? The other side is, look, people are desperate for income now, and so people are going to be reluctant to say, "What do I do if I give up my X stock, which I get my 3% dividend or my appreciation that I'm going to get? I need this income because I'm a retiree or because I'm going to retire, and there's no alternative right now." But when the Fed starts raising rates, then it could be very gradual because it could follow the path of the Fed raising rates. I just realized that.
uh,
So look, if the Fed says, "Oh, I'm only raising half, but this will be it," or "I'm only raising a quarter," oh, everything's great. So some people say, "You know what? It's getting a little higher. I'll buy some bonds." I actually bought some bonds this week in a Roth IRA with a high coupon. By the way, I looked for that, although it doesn't really help that much. But I got a 3.75 coupon, but you pay more for that, so it's really illusionary. But you get your money back faster, at least on the coupon, in the way it looks. So. But I bought some bonds for the first time. I was like, you know what? If it goes to 4, maybe I'll buy a lot more bonds or 3. So the money, because now you have an alternative. But this is the dilemma of the Fed, the dilemma of the energy markets, but also the dilemma of the investor. Because now, okay, you have your cash sitting around, but you go, well, I can't live on this the rest of my life. So when do I put it in? What do I do? But for me, I like your idea of having more cash on the sidelines right now because I see a lot of, and also the most defensive stocks. As I said, I was shocked they pulled out of RHS and P&G, but you know what? I'll give you, an example of, before we go into dividend stocks, because I want to give you an example of what I do look for. I have a lot of these, but I want to just mention 2 things. So one of our readers asked about, our viewers asked about gold. So I found this. This was very interesting. And it says gold lost its shine. And it says performance during inflation. And this is what I kind of felt. This is why I have 3% in GLD, which is just a hedge, but it's not a certain hedge because there were 3 periods of high inflation in this chart: 1988, 1980, and 1973. The inflation rates were, I'm rounding off, 4, 6, and 8% a year. And by the way, some of these were long, like 1973 to 79 was 8% for 6 years. 80 to 84 was 6.5% for 4 years. That's not good for the market. But gold's returns were minus 7.6%, minus 10%, and plus 35%. So what does that tell you? It tells you who knows what gold is going to do. So, and that's really my conclusion on gold more than anything is I have no idea. If there's a lot of inflation and consumers are hurting, maybe India's hurting or China, maybe gold goes down, but it's a good hedge because it's diversified against most other things. Also,
I wanted to ask Nick, what is your strategy? How you are handling these volatile markets these
Well,
days?
I check my portfolio once a week, Sasha, and I'm up 0.09% because I had a big loss, obviously, in NVIDIA, but it was made up by all the energy stocks. So,
yay.
yeah, so the energy stocks are holding my rear from my tech portfolio. So that's really where I sit today. I'm not a lot into cash, but I have a professional money manager. I know that they put money in bonds and all this other garbage. And the problem with bonds, Peter, is interest rates go up, those bond portfolios go down.
Unless
So
if you're
unless
holding,
you're going to unless you hold to maturity.
well, I buy bonds themselves, so
Yeah,
I hold them. I always think I'll
yeah,
just hold it to maturity, so I
sure,
can't lose any money. I
right,
get the interest rate, but so I'm like 45% bonds,
yeah,
but muni bonds but yeah,
yeah,
if you hold it to maturity. Now, if you buy a mutual fund, who knows what'll happen? That's why I'd rather hold the actual bond, rather because I know I can control it and I don't have to sell it.
yeah,
So, but
yeah,
but you have
yeah,
to be careful, Nick. Be very careful in the
yeah,
market. You have to
yeah,
look at all your holdings. Look at the debt to asset ratios.
sure.
Also, I wanted to cover True Simple really quickly
Too
because
simple. Okay,
another reader asked me that, and I promised I'd look at it. I
yeah,
looked at it for a
please.
while. So it's an interesting company. It's very hard to call. Um, it's a company that it's, first of all, very speculative stock. So don't think I'm recommending it because it's not my style. I want to do dividends and sell options like on the show. I'm just not a big risk taker with few exceptions. But they develop driverless trucks basically, And there's some huge pluses here and huge minuses. So the minuses include the price has gone down from 70 to 15. The CEO just announced that he's taking over. The head of the owner of the company said he's now going to be CEO and chairman, and the stock went down 2/3 on that day from a low price to even lower. People did not like that move. I guess they lost their CEO or something. So it's a huge spec either way. So the cash flows have gone -10, -71, -110, -280 million. So they're spending a lot of money. But then there's big pluses. They had a very successful test. The stock is around, I think it's around 15 now, or no, I sort of started at 11. Morgan Stanley says it's worth 45. Credit Suisse recently. Credit Suisse says it's worth 33. They're in a competitive situation, but they're in the lead right now for driverless trucks. So this could be a tremendous company or it could be a bomb. Nobody can know. So it's the kind of thing you put a little bit in. Like I have a very 0.5% of DWAC because I think it could be a Google or nothing. By the way, I want to mention I get 50% interest on my DWAC stock now by lending it out. So I'm getting huge cash flows on that, and it's just staying flat. So we'll see what happens. But I may get all my cash back just holding it or more. It's an investment if it just stays where it is. But who knows what it'll do. But so it's extremely speculative, but I wanted to address it. And I'm not saying don't or do, but don't have too much in there. And maybe you want a little, a bit of it, because it could be one of, a huge success too. It has a lot going for it and a lot of risk. So I wanted to mention
what else interesting you are doing?
And then, so I was going to mention, so this is my new pick today. And interestingly, they came out with a report today after I bought it. I was already buying it and decided to buy even more this morning. And then I saw the report. I said, oh my gosh. So this is the kind of company I found a lot of them. It takes so much work. I could spend a whole week just looking for one company that meets all my criteria, which is I want a lot of cash flow, a good dividend, a safe sector, and I also want now low debt, which makes it even tougher. So, but this is an interesting one. I've mentioned it before. It's done reasonably well. I've had a lot of big winners in the last 6 months, but Village Supermarkets. So I'm going to mention this again because it's a perfect one. And I just raised it from 0.5% to 2%. Because if I'm selling all this RHS, which is 8% of my portfolio, and P&G and a couple other companies, I'm weaning it down to the most safe stocks. I'm trying to have some yield or some, anything besides tech and oil. So, so here's Village Supermarkets. They've got I want to mention one other thing too but I'll say this first. So they have a 4.3% dividend, which is nothing to sneeze at. Their cash flow is, their price over cash flow, which I look at, is equivalent to a 17% cash flow yield. So they're bringing in 17% cash flow. Their debt to assets is 0.11, 11%. So they have almost no debt. They own 37 ShopRite supermarkets. And I know from personal experience, they have good prices. We don't use them, but they have good prices. They're really well run. So, and they haven't, the only negatives is they haven't increased their dividend except for maybe once. And they gave a special dividend once, but this is a perfect buyout candidate. So I'll just sit on it for 4.3%. They're again, and so they come out with a report today. Their net income is up 122% year over year. Their store sales increased 4%. Their operational costs went down, and I just view it as a bond substitute with a lot of upside.
Right.
So, but look, if inflation kicks up to 30% or whatever, I think it'll do fine because food prices will go up. I'll get the 4.3. It could wear a lot. It has almost no debt. It could just pay it off 1, 2, 3. So that was a really safe one that I found, and I'm going to try to move away from oil. But I want to mention, so just as a hedge against oil prices, because I want to hedge the other stuff, even although now I don't have to hedge RHS anymore, but I bought just 1/3% in CNQ and DWN, which is Devon. So it's only 1/3% each. But I think they're oil companies, and I like natural gas much more than oil, and I like pipelines more. But these are more in the production realm. CNQ is in Canada, but they both have dividends of 4 to 6%. Devon's is variable. But if oil is going anywhere near what I think, then anything else I have is going to, a lot of things I have, even with the defensiveness, is going to be affected. So having a little bit in pure oil is fine. If I lose the 2/3% over the years, I don't think I will anyway, because I don't think oil is going down. So I like those two, CNQ and DVN, and I like VLGA, Village Supermarkets, VLGEA, just because it's got the nice yield. I think it's got potential growth, and it's very safe. And I am moving to safety.
Yeah, I agree with you on that. And what I'd like to discuss one thing. Sometimes I treat, generally speaking, this as a chess game.
No.
In chess, it's not important what you think about position and what to do, but very important is to think what's your opponent is going to do and why and how to use to your advantage. My observation is that there are a lot of Peter, you as a ex Wall Street professional, you should understand that the cash influx into the market going every second, all the pension funds and mutual funds, just all the S&P funds, which just follow S&P index and do nothing else. Um, that alone and that cash is not going to disappear anytime soon. So there are some funds that cannot do anything but buying
Right.
stocks. They cannot
True.
buy bonds
Yeah.
or do anything. So that alone, as long as it's continuous, and I can't figure out how it will not continue, it will. So
Well, I know how it won't. Go ahead.
No, it won't
well,
also.
listen, I don't care if the market will drop 50% from this level, which will be
Yeah.
probably 70% overall from its highs. The money will still continue to come in.
Well,
Well,
that's yes and
the
no.
yes and no. See, here's the problem in 2008, since we were managing 300 pension companies around the country with about a million to 2 million each in it. So that's like 500, 600 million. But let me tell you what happened, Sasha. Okay, these people withdrew their money out of the funds. In
That's what I
other
was about
words,
to say.
yeah. In other words, the thing is, you think the money would keep on going, but let me tell you something. In 2008, I had a lot of panic. Speak about panic. I had
Yeah, there
clients
was money.
panicking
Sure.
about because the market dropped 37%, and you know what they did? They just wiped themselves out of the fund, so that money wasn't going back in the S&P 500. It was going into cash to the extent
Right.
they could. And I had some clients, I told them, hey, they were scared even in our annuity contracts. I had one doctor had like 800,000 annuities, and the insurance rate back then was 200,000. He actually liquidated and took a $20,000 hit on a guaranteed fixed annuity. I was saying, and it was with Principal Financial, a $500 billion company. But that stock dropped from 37 to 8.
Wow.
Okay. And he was scared to death that the whole thing would go under. And so what you have is you get this panic mode, and these people just withdraw out of all the funds, and you end up
Yeah. It could happen.
Well, what's happened in
happened in
2008?
2008, man. They were just
It was a tragedy. I can
A
call it that.
mortgage crisis. Yeah.
Yeah, a mortgage
hey,
crisis.
listen, we went from
That was
300 plans to
comparable only
But there's been
120.
other
to
panics historically. I mean,
Yeah.
look, I'm not promising anybody there's going to be a panic, or it could be gradual or whatever. But I just don't like the look of things right now. I think the downside is tremendous because everything's so hyped up. But you're right. Where do you put your cash? But the other side is, let's say you're a retiree and you're gonna retire and you're going, oh, I have 400,000 or some amount in my pension, and I'm gonna retire and I just lost 20,000 or 50,000. I need this money, So now all of a sudden you switch your 401k to cash, or if you're mutual fund, I'm going to sell my mutual funds. Outflows of mutual funds are not impossible. So I
Right.
mean, again, who knows? The market is very random, and who knows where anything's going.
Another problem, Peter, because we had an uptick on our annuity contracts, so they're paying about 2.83. They're starting to get back to that 3% level.
Yeah,
But here's the problem. What's inflation?
right.
It's
That's
like
the problem. I
7%,
know.
9%. So the
This is
sad
why the
part,
investor's screwed.
that's what I'm saying. The sad part, they put the money in the safe annuity contracts
I know.
that pay out 3%, but inflation pushes up to 7%. They lose money every time they put money into our contracts. If they don't get inflation under control, we haven't had
I don't
withdrawals.
think it's going to be. I
Yeah,
think
but
we're in
but you see the problem.
for
If you go to
years.
if you go to cash and you go to these fixed accounts,
Oh, I know. It's a
okay,
terrible
and you're
situation.
getting like next to nothing, and inflation is pushing up 7 or 8%,
I know.
you're falling behind every year that you're doing that. So
I know.
the investors in a squeeze, which is one reason I'm still happy being with the dividend stocks, because they have hard assets that move up with inflation, where cash is not a hard asset and does not move up with inflation.
But
It's just
check those
cash.
debt to asset ratios, Nick. Debt to equity or debt to
Yeah,
asset.
but mainly these
It's
are
a
stock.
new analysis. It forced
Hey,
me to change my
Peter,
thinking.
these are mainly stocks you and Sasha are recommending, so I'm pretty sure
Well,
the debt
remember,
to
I
asset
change
ratio are
sometime.
good. What?
I do
I'm,
change sometime, as long as
I know you do,
you show up on the show. You know.
I've been tracking it, and like every time I look at it, I go, well, I'm starting to keep. I'm up 0.9%. My big loss with Nvidia, but a couple weeks ago it was actually USAC, and
Oh, USDC
USAC,
has been soaring now.
USAC, since I was crying about it, is now
Yeah,
up
I
over
know.
11%. 3 weeks ago I was crying about it. Now it's up
I
11%.
said it. It's
So it's my big loser.
those are MPLX EPD is I have 2 or 3%. USAC now has grown to 11%. I'm
Really,
sorry, to 6%, and MPLX is over 20. But these are all cash flow machine pipelines
that's
that
what I
I
thought.
love, and they're all natural gas oriented, either natural gas liquids.
Sure.
Europe's going to need more and more natural gas. I read that um, right now we export 10% of our natural gas to Europe, and that's projected to go to 27% in the next 5 years.
Yeah.
And they've already built a lot of these plants. So even if Biden wants to put in a rule, no new plants, a lot of these are already under construction. So, and Europe is going to need the gas.
I didn't abandon USAC, but I
Oh
did
yeah,
abandon FireEye several months
yeah,
ago, and it went. Amanda Dent just sold the company. I mean, this guy's a wildcatter. He sold it for 23 a share. I think I bought in 21, sold it 17. If I held, he sold it to 23. But there's this little play that exists in the market. The stock is going for 22. The buyout price is 23. I've played this game before. You can
right.
actually invest heavily at 22, expecting that it'll close at 23.
Unless it
What?
doesn't close.
Yes. Okay. I've done both. I've done both where it had closed. I made a
Right,
ton of money. Then I did one where it didn't close and I lost a ton of money. But
right.
you have that. You always have that little spread between the price that Google is asking or going to buy it and the current price. And right now it's about $1 a share. If you want to play the man to debt game, I call it. Um, for $1 a share, you got to invest a lot of money.
You know
Obviously,
what? Google, I don't know if I would do that because it's not my style. Again, I want to hold things for life when I can. But Google has a lot of cash, so they'll probably just buy it.
Probably
well,
they will.
that's what they said. They made a deal to buy it, and I'm sure they're going to.
Yeah,
But
they're like,
if you're,
what's this to us? It's like a penny. It's like
yeah. But the thing is, if you want to play the game right now,
right.
you have $1 a share spread.
Hmm.
So a hedge fund manager may go in and just buy huge amounts of shares at 22. I haven't looked at it recently, but I'll tell you, every hour as you get close to the closing date, that price gets squeezed. And right now
Yeah,
it's $1 a share, then it'll be 75 cents, there'll be 50 cents. I've played that game before. It's kind of cute because you make free money on the close. But
yeah.
I've also seen where the close got bounced by the FTC. I took a bath on the other side. It's kind of I call it, it's like a chess game, Sasha. It's a cute little game you can play. Okay, you can pick up $1 a share, free money, or you can get bounced and you just have to play the
Well,
game.
because the purchaser is Google, so it's a low risk investment, I would say.
Yeah.
If the deal will not close, then they will go down to $15 a share.
Yeah, then you lose your shirt. I know
Likelihood,
the game.
likelihood of that is not great because Google probably will proceed.
Yeah,
Most likely.
probably it'll close. Yeah,
So
Yeah.
probably at this point, maybe the good strategy is okay, unless you're so scared that you can sell all your holdings 100% and
no,
just
don't
stay
do
in
that.
cash for the time being. Very few people will do that. I'm quite sure. So remember, I recommended and I have position at TZA. It's a triple index which actually going up when the market goes down. TZA.
Oh,
So I remember before this market ran down, they were worth $25 a share, $24 a share, so on. But I kept it as a protection. So now they're 35,
Oh,
36
wow.
dollars a share. But I'm not sure that I wanna get rid of it because it's a protection. And another thing is you can buy puts on probably Nasdaq 100 or S&P 500, or just buy protective puts. So if there will be a panic selling, which may materialize after all,
It could. It could.
so to buy these protective puts will make you a lot of money. The problem is this, because it's very unclear if and when that will
Right.
happen. So
Exactly.
be prepared to lose all your money,
Yeah.
unfortunately. But if you are looking for protection, that is protection. I'm not aware of anything else how you can protect your holdings.
Well, my protection is basically stocks that'll do well in inflation with dividends and some cash now.
Now, what I like about high yield dividend stocks, because I already said that they're not going down as the market is, they hold their value pretty well, they continue to pay dividends, there are likelihood of raising dividends or buying their own shares. But there is something else, again, when I was talking about chess game. Who
Mhm.
are the holders of these high yield dividend stocks, right? High net worth individuals. They are not going to run down and sell their stocks, because by the time that they will get down so much, their dividends payment, let's see, which is now probably say 7%, will go up to 9%, 9.5%. They will never find
It is a
replacement.
pad. It is a pad. Yeah.
Yeah,
It'll help.
I
It'll
mean,
help.
it's so they will hold. In fact, probably I would recommend even to add to the positions. Not now, but if they will really start going down, that would be a time to look at increasing your position. So, because I see people who are buying AMC and GameStop stocks or so on,
Oh,
they
no.
don't touch
That's not our show. Yeah.
dividend stocks, right? So they don't. Now, what about bitcoins? Maybe the way to arrest the
Yeah. It wouldn't.
inflation.
I
Maybe
wouldn't touch
rather
this. I
than
think we're
buying
running out of time, though, Sasha. I
bitcoins.
hate to close the show because there was so much to talk about in the news this week.
Sure, we'll talk about next week to a little bit about. See that now this cryptocurrency is the way how Russians are going to avoid all the sanctions and so on. So maybe they will become much more
Maybe
popular.
it'll be a bounce.
Maybe we'll see. We'll see during next week. And I want to thank you very much for participation in the program. Goodbye, everybody, and see you all next week. It's IBM Pod TV investment show. Thank you very much. Bye bye.